residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG1 overview of Chapter 5. Notes print. Leave a comment. Overview of Chapter 5. In this chapter, we will discuss financing terms and cash equivalency. This is the second element of adjustments in the suggested sequence. Financing terms include various types of mortgages, and so we will discuss amortization and the different kinds of mortgage payments that may occur, including fixed rate, graduated payment, and adjustable rate mortgages. We will define and illustrate conventional and non-conventional mortgage types. Sources of mortgage money will be identified, and various kinds of creative financing techniques that have been employed. These include points, mortgage assumptions, and wraparound mortgages. Different types of sale concessions will be addressed, including paying of points and buydowns. Cash equivalency will be discussed, and guidelines for making cash equivalency will be presented from Fannie Mae and HUD. Mathematical techniques for calculating cash equivalency will be illustrated. However, it will be demonstrated that the final adjustments should be based on market reactions, not mathematical techniques. End of page. Chapter start. 26%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG2 learning objectives for chapter. Notes print. Leave a comment. Learning objectives for chapter. Upon completion of the chapter, the participants will be able to explain pertinent financing terms, summarize various types of mortgages, distinguish between conventional and non-conventional loans, summarize the primary participants in the secondary mortgage market. End of page. Chapter start. 26%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG3 Chapter 5 financing terms and cash equivalency. Notes print. Leave a comment. Chapter 5 financing terms and cash equivalency. Financing terms and cash equivalency. In the last chapter, we mentioned the suggested sequence consisting of 10 elements that may require adjustments in the sales comparison approach. This chapter will be devoted to the second item, financing terms and cash equivalency. First, we will discuss some of the basics of financing and look at common financing vehicles. Adjustments may have to be made in certain circumstances when a comparable sale may have been sold with atypical, i.e., non-market, financing. The financing may be considered atypical due to the interest rate, amount of down payment, points paid, concessions given, etc. Often, adjustments are necessary for sales concessions, for example, seller-paid closing costs. The whole point of making adjustments in the sales comparison approach is to equalize the comparable property to the subject property. When we make adjustments for financing in a market value appraisal, we adjust the financing of the comparable sales to market financing. We will cover that later in the chapter. End of page. Chapter start. 26%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG4 mortgages. Notes print. Leave a comment. Mortgages. Most homes in the United States are financed by a long-term loan secured by a mortgage on the property. A mortgage is defined as a pledge of a described property interest as collateral or security for the repayment of a loan under certain terms and conditions. Lenders are eager to offer real estate loans secured with a mortgage because real estate has traditionally been very good security as it stays in one location, typically appreciates in value, and has a long life compared with most other assets. End of page. Chapter start. 26%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG5 conventional mortgages. Notes print. Leave a comment. Conventional mortgages. Mortgages come in a seemingly infinite variety, but most common are conventional mortgages. Conventional mortgages are defined as mortgages that are neither insured nor guaranteed by an agency of the government, although they may be privately insured. Many conventional loans do have private mortgage insurance, PMI, covering part of the loan. PMI is often purchased for loans that have a loan-to-value ratio, LTV, that exceeds 80%. End of page. Chapter start. 26%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG6 non-conventional mortgages. Notes print. Leave a comment. Non-conventional mortgages. Besides conventional mortgages, there are some that are guaranteed or insured. Guaranteed mortgages, a mortgage in which a party other than the borrower assures payment in the event of default, example, a VA guaranteed mortgage, or a SBA guaranteed mortgage. In the event of a default of a VA guaranteed mortgage, the VA would reimburse the lender for any losses. Insured mortgages, a mortgage in which a party other than the borrower assures payment on default by the mortgagor in return for the payment of a premium, example, FHA insured mortgages, private mortgage insurance, PMI. In an FHA insured mortgage, FHA does not lend the money. However, they charge a variable premium as an insurance charge. They insure the loan against loss by the lender. In the event of a default on an FHA loan, the lender would be reimbursed by the FHA. End of page. Chapter start. 27%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG7 mortgage priorities. Notes print. Leave a comment. Mortgage priorities. No matter what type of loan it is, the priority of the mortgage is important. Let's look at two definitions. First, mortgage, a mortgage that has priority over all other mortgage liens on a property. Junior liens, a lien placed on property after a previous lien has been made and recorded, a lien made subordinate to another by agreement, example, second and third mortgages, also called second lien or third lien. Priorities are an important consideration. If there are second or third mortgages on a property, they carry a higher risk and therefore, typically a higher interest rate. They don't get paid off unless and until the first mortgage gets paid. Assume there is a first mortgage of $100,000, a second mortgage of $20,000, and a third mortgage of $10,000. The property is foreclosed. The examples below are based on this scenario. Example 1. The property is sold at foreclosure for $130,000. Each mortgage gets paid in full. This is rare. Example 2. The property is sold for only $125,000. The first mortgagee gets paid in full, $100,000. The second mortgagee gets paid in full $20,000. There is only $5,000 left, and that would go to the next in line, the third mortgagee. Example 3. The property is sold for $110,000. The first mortgagee gets $100,000, and the remaining $10,000 goes to the second mortgagee. The third mortgagee is out of luck. Example 4. The property sells for $90,000. All that goes towards satisfying the first mortgagee, and the other two receive nothing. End of page. Chapter start. 27%.